All right. Well, in U.S. markets, when a hot venture-backed startup comes public, the stock goes to the moon. Everyone goes home happy. We talk about how it's the future of all kinds of commerce. In the U.K. markets, hot venture-backed startup comes to market, and the stock tanks. Oscar Williams-Grut joins us now to talk through what is going on with shares of Deliveroo today, and also, what happened with the IPO, and also the retail angle here. I think is an interesting part of this story as well. 70,000 individuals with about £1,000 of investment in Deliveroo, and it's been kind of a strange offering here, and certainly doesn't bode well, I would think, for the LSE going forward.
No, not at all, Myles. There are a lot of losers today here in London. As you say, Deliveroo conducted its IPO today, officially listing on the London Stock Exchange. It had raised about £1 billion, offering shares at 390p each, which was already at the low end of its initial range. But despite trimming, going as low as it could before the start of trade, shares fell 30% on its debut this morning. Pretty unheard of drop. That wiped about £2 billion off the value of the stock in a matter of minutes. It's still down about 25% as we speak. As you said, this is bad news for retail investors. About 70,000 of them bought in the IPO through a platform called Primary Bid. It's also bad news for Amazon. Amazon is the second biggest investor in Deliveroo, has just over a 10% stake in the business after this float closes. It's also, as you say, bad news for London. A lot of the politicians here and regulators and people at the London Stock Exchange had hoped Deliveroo would be the kind of standard bearer for a new group of tech companies coming to market here in London. Obviously, tech companies have traditionally shunned London in favor of New York, but recent reforms had meant to address that. But it turns out that you can change the rules, but that doesn't necessarily change investor appetite. We've had a string of big institutions rejecting this float ahead of the listing. Aviva, Standard Life, M&G, all start citing concerns around things like the treatment of riders, concerns of the dual class share structure, the company's valuation, and persistent losses. Now, Deliveroo did lose over £200 million last year on revenues of about £1.2 billion. But compare that to DoorDash, which is a very similar business. They lost over $600 million last year on smaller revenues. As you say, it starts to throw the comparison between New York and London into focus. This doesn't bode well for companies looking to list in London in future.
And Oscar, another company, UK-based startup, Kazoo, is they're going to list in the US. I think they're going to SPAC over here. And I'm just curious, you mentioned some of those big institutional investors that aren't on board with, the dual class share structure, some of the other ESG elements maybe of Deliveroo, the employee, treatment, so on and so forth. Like, is there any path forward in your conversations, in your view of, kind of finance in the UK now that folks might change that view? Or is it just, we're gonna let the Americans, kind of do all these concessions, stocks will go up over there, and we plan to manage our affairs the way that we see fit?
I think we're on a journey here. I mean, when I speak to investors here in London, they recognize that we need to get some more tech stocks listing here in London, because that's where the growth has come over the last decade, and probably where it will come from in the next decade. But there's still a sense that the understanding of how these companies work can be valued, and how to approach them isn't necessarily there for the public market investors. That said, a lot of the people I'm speaking to today also say that many of the issues that have made this such a bad IPO for Deliveroo are quite concentrated to the company itself. For example, concerns around the treatment of riders. They treat them as independent contractors, but as we've seen for Uber here in London, regulatory change could make that more of an issue and push up operating costs. In their prospectus, they disclose they're facing investigations in Italy, the Netherlands, Spain, all across Europe. And so I think that is one of the big question marks here. But certainly, there is a journey to go on in understanding things like dual class share structures. This has only just come in the last few months. So I think investors want to take a little bit longer to get comfortable with this, and particularly when it's married with a business model like this that they already were a bit iffy with, it's not a good combination.
Yeah, it's just it's interesting, Oscar, from the American perspective to see folks in 2021 say dual class share structures are bad. I mean, it's been table stakes for U.S. new tech companies really for over a decade now. I don't think they're great, but everyone here says they're fine. Investors say they're fine. The stocks go up all the time. So interesting to see how that evolves as we get through the next decade here of capital markets. Oscar Williams-Grut joining us live from the UK.